Since the Industrial Revolution, we've watched these massive global industries rise and, well, fall. Think about textiles, railroads, big oil. They all had their time on top. Today, it's all about tech. But lurking in the background through every single one of these eras, there's been one industry that has remained a constant, powerful force, kind of steering the ship, and that's global banking. So how did this one industry get so powerful and, let's be honest, so misunderstood? Let's get into it.
Right. Unlike all those other industries that hit their peak and then faded away, banking just keeps going. It adapts to every new boom, making itself essential, while other business models become totally obsolete. For centuries, it's been this silent superpower.
And yet, for an industry that's so central to everything we do, it's deeply, deeply misunderstood, and frankly, a lot of people hate it. And when you ask why, the explanations often spiral into some pretty wild conspiracy theories. People point to things like soaring debt and financial meltdowns, like the 2008 crisis, and they blame the banks, who, by the way, only seem to get richer while the world feels more and more fragile.
So that's what we're going to dig into in this explainer. We're going to look at that tension. What role are banks supposed to play in our economies? And maybe more importantly, what role do they actually play? To figure that out, we've got to go way back to the beginning.
You might be surprised to hear that the origins of modern banking are, well, they're pretty humble. It wasn't born in some grand palace or government building, but in the simple workshop of a goldsmith. And understanding what happened in that little shop is the key to unlocking the most valuable asset a bank can possibly have. Okay, so first off, trading with actual gold was a massive headache. You had to ask, is this chunk of gold even pure? Is the weight right? And am I going to get robbed carrying this around? So goldsmiths solved the first two problems by minting coins with a guaranteed weight and purity stamped with their seal of approval. Then, to solve the security problem, they'd offer to store people's gold in their super secure vaults for a small fee. And that led to the real game changer. They started issuing these fancy, hard-to-forge deposit receipts for the gold they were holding. And just like that, you had the world's first banknotes. And that right there is the foundation of the entire system. It's so important. People accepted those coins, and later the paper receipts, not because the paper itself was valuable, but because they trusted the reputation of the goldsmith who issued it. That trust was, and it still is, the single most important asset in all of finance, period.
But of course, things didn't stay that simple for very long. People quickly realized it was way easier to trade with those paper receipts than to lug around heavy gold coins. And when the goldsmiths noticed that, well, it led to a turning point that completely transformed banking from a business of just storing value into a business of creating.
So here's the trick. The goldsmiths realized that people almost never came in to exchange their receipts for physical gold all at the same time. So if someone came asking for a loan, the goldsmith could just write them a new receipt, one that wasn't backed by any gold, and then collect interest on it. Now fast forward to today, and commercial banks do the exact same thing, just digitally. When you get a loan for a house, the bank doesn't take that money out of someone else's savings account. Nope. They just type the numbers into your account and poof, the money is literally created out of thin air at that very moment.
This kind of power has always been, well, controversial. There's this famous quote, you've probably heard it, often pinned on the powerful banker Mayer Rothschild, that captures the feeling perfectly. Now, to be clear, there's zero evidence he ever actually said this, but the fact that the quote is so popular tells you a lot. It shows how the whole murky, complex nature of money creation is the perfect breeding ground for suspicion and conspiracy theories.
And this modern system of creating money has a really profound consequence. It directly ties the existence of almost all money to the existence of debt. So get this, the old goldsmith's absolute nightmare was a bank run, right? Everyone showing up at once demanding the gold that he knew wasn't actually there. But today's system, it has the complete opposite fear. The nightmare isn't everyone trying to withdraw their cash, it's everyone trying to pay off their debt. So why would paying off debt be a bad thing? Well, let's just look at the raw numbers. According to the Federal Reserve, the M2 money supply, that's basically all the physical cash plus all the money sitting in checking and savings accounts, is somewhere around $18 trillion.
Okay, now hold that number in your head and compare it to the amount of debt out there. If you just add up the U.S. national debt and total household debt, you get a number that's way over $40 trillion.
And this really shows you the problem. Imagine this first bar is all the money that exists in the entire economy. Now look at this much, much taller bar. That's all the money that is owed. You can see it right there. There physically is not enough money in existence to pay off all of the existing debt. The system actually needs debt to keep growing just for everything to keep functioning.
I know, it sounds like a trap we can't get out of, but it doesn't have to be.
According to the economist Professor Richard Werner, this debt-based system isn't automatically doomed to fail. He says the problem isn't the system itself, it's how we're using it.
Werner argues that we have to see the difference between two kinds of lending. The first, and most common today, is non-productive. This is money that just flows into things like mortgages. It doesn't create any new goods or services, it just inflates the price of existing stuff, like houses. This is what creates those dangerous asset bubbles and instability. The alternative is productive lending. This is when money goes to fund new businesses, new factories, new tech. It creates real, tangible stuff and leads to sustainable growth. And we have examples of this. Just look at Germany's system of smaller community Volksbanken, or people's banks.
So, the path forward according to this idea is pretty clear. We need to shift the focus of our entire banking system away from just speculation and back towards actual production. That means encouraging smaller, local banks that actually know the businesses in their community. It means getting more loans to entrepreneurs who are creating real